tell us exactly what you mean by alternative investment solutions.
Sure. And alternatives can mean a myriad of things, but the simplest explanation is an alternative investment is anything besides stocks, bonds, and cash. So you look at the traditional asset classes, stocks, bonds, and cash, and anything outside of those can be classified as alternative. Now, under the alternative segment, I like to break that up into two different areas. Number one, there's liquid alternatives, which include hedge funds, commodities, currencies, crypto, things such as that. Liquid meaning you can buy and sell readily. Then the second part is illiquid alternatives, meaning private equity, venture capital, private real estate, private credit, things that you can't readily liquidate, buy and sell, and you typically don't get a mark-to-market valuation on those private assets. And then there's certain subsectors, like if we want to talk about hedge funds, there's basically approximately 10 major hedge fund strategies, whether it's long-short equity, the most popular, multi-strategy, global macro, arbitrage, market neutral, managed futures, and several others, distressed debt, and so on and so forth.
Love that breakdown. Yes, liquid versus illiquid. And so excited to get into those discussions further, deeper.
Yeah, and the other thing that I should add with respect to alternative investments is what I consider a true alternative is something that has low, no, or negative correlation to traditional asset classes. And that's why they're viewed as portfolio diversifiers. Because if you can generate an attractive return that is generally uncorrelated with traditional asset classes, that to me is the true essence of diversification.
Agree. Now we're going to have a definition of what you mean by traditional asset classes, so we know it's not that.
Yeah, so the traditional portfolio is generally regarded as the old 60-40, 60% stocks, 40% bonds, and that's generally consisting of US stocks and bonds. So call it for stocks, the S&P 500, and then for bonds, a mix of treasuries and corporates, largely on the American exchanges. However, in contrast to that, if we consider the global market portfolio, US stocks and bonds are only typically like a relatively small portion of that, less than a quarter for sure. So the traditional 60-40 portfolio is only a fraction of the global market portfolio. And so some consider that taking an active bet, not quite as passive as some may think. But it is generally low cost if you utilize ETFs. So that's a good thing. However, what 2020 showed is that 60-40's track record pre-2022 was very good. However, in 2022, it suffered a pretty devastating setback, drawdown of a negative return of approximately 20%. Stocks and bonds became highly correlated. Traditionally, they were viewed as diversifiers. I remember talking to some professional allocators about 18 months ago, and this was back when the 10-year was yielding 100 basis points. I asked them, why do you own 10-year treasury bonds yielding 1% when inflation's higher than that? They told me, well, those treasuries are there to protect our stock portfolio for when stocks decline, as they generally do. Every, call it 4 to 6 years, we get a bear market. And that thesis was proved just enormously wrong in 2022. The 60-40 portfolio was certainly a beneficiary of the 40-year decline in interest rates, basically from the early 1980s to call it about a year and a half ago. And they've done nothing but mostly go up since then. 10-year peaked above 400 basis points, up from a low of 50 basis points. Now it's below 3.5. That being said, many, including myself, believe that 40-year bond bull market is over. We're in a new regime where we're having high inflation. And if you look at the data, historically, stocks and bonds haven't been negatively correlated. More often than not, they're more so positively correlated. In addition, in an inflationary environment, they are usually positively correlated. So that 60-40 portfolio lost its main diversification benefit